Hey, Jason here. Today's video I'm going to analyze Pinterest and answer the question, should you invest in Pinterest? Stock ticker PINS. This is a stock analysis for Joel B. Joel B, who asked me to analyze this company on YouTube. Before I get to that though, I need to let you know you can get this series of podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video and our other content on YouTube, make sure to subscribe and hit the notification bell so you're notified every time we release a new video, and release new videos all the time. Okay, before we get to that analysis, again, I apologize if you watch my other videos. I apologize for this. I don't want to do it. I hate doing it, but I have to do it because every time I forget, I get nasty comments. So, this is for educational purposes only. These are requested by viewers. These stock analysis videos are requested by viewers. They want to take a look at a stock for them. This is for educational purpose for them, and it's for you to, so you can learn tips and tricks on how to spot potential red flags in investments faster, so you can spend more time evaluating better stocks. This criteria that you're going to see here is based on my preliminary analysis checklist that I developed over the last 15 years of investing. It works for my purposes, and it's what I'm going to talk about is ultra conservative. Because of that, I don't care what a company does in the future. I don't care what it says it's going to do. I don't care about its story. I don't care about the momentum or the emotion that's going behind on the company right now. I don't care until I get this on this initial stage, which is what you're seeing here. A company has to surpass my minimum thresholds, or I don't even get to that other stuff. That's down the road. Because of that, I purposely, in most cases, don't know what the companies do. And I don't care about what they do until later. Why should you listen to anything I'm saying? Because in the first 9 years of my career, I produce average annual returns of 23.5% per year on average, not compounded, in the portfolios I manage. That puts me just behind Warren Buffett in the first 9 years of his career, when he produced 24.2% returns for his limited partnership. My returns in the first 9 years of my career legitimately make me one of the best stock pickers in the world. I'm not saying that to brag. I'm not saying this to brag. I'm saying this to give you context and hopefully let you know that I know what I'm talking about at least a little bit. And hopefully you can trust what I'm saying at least a little bit. Okay, again, sorry about that. I don't like doing that, but I have to do it. Okay, so today we're going to analyze Pinterest for stock ticker PINS for Joel B, who requested this on YouTube. So let me bring the screen over. Okay, so Pinterest, like I said in the intro, I don't normally know, because viewers pick these stocks. I don't normally know what the company does unless I've researched it in the past. Obviously, this is a big enough company that I know what they do. They're online. I don't actually use Pinterest. I think my wife does. I don't even know if she uses it anymore, to be honest. It's an online picture site. I'm not even going to try to describe it. Actually, I'll stop right there because I've never once used it, and I don't know what it does exactly. I know it's an online kind of social network place. That's about it. Okay. Size, $38.5 billion. It's pretty big. Forward PE, I don't care much about forward PE, but when I do, I want it to be under 20. So this is one sign at 65.4 that the company could be substantially overvalued. And I don't care about price of sales at all, but with this being almost 20 at 18.7, this is another sign the company could be overvalued by a significant margin. Okay. So revenue is up, what was that, 4 times since 2017 when it IPO'd, from 473 million to 1.91 billion rounded up. Very good growth there in the revenue. But with that growth, they've had to spend a lot of money, it looks like, because they've lost money every year they've been a public company. In 2019, they lost 1.4 billion. Which I would want to know, if I was to invest in them, why they lost so much money then. Maybe something related to IPO expenses, like paying out options, restricted stock, stuff like that. Maybe they acquired another company. I'm not sure, but that's a gigantic loss in that year. However, in the last 12 months, they've only lost $19 million in operating profit compared to $1.91 billion in revenue. Still not great, because on the operating margin, I like for anything above 10% on a consistent basis. Positive 10%, that is. So still not great, but losing $19 million on almost $2 billion in revenue is not not necessarily a gigantic red flag either. Okay, its share count. So because it's losing money and it's losing money on its operating basis, it has to raise money from somewhere to continue operating and growing. So what it's been doing, one of the things it's been doing, is selling shares. It's sold in 2017. It had 449 million shares outstanding. Now it has 609 million. I talk about this in a bunch of videos. This is a big thing for me, is share dilution. And I wasn't going to explain it, but I will explain it here just in case you haven't seen the other videos. If you want to see those other videos, you can find them in the description, in the link below. I think we have the link to the playlist where all these videos are kept. So I talk about this in many videos. I'm not even going to try to name all of them because it's a lot. But what this means is, think of this like a pizza. Think of this like a pizza. Let's say in 2017, let's use a round number, because I don't want to do the math in my head, to be perfectly honest. Let's say they had 500 million shares in 2017, and then they upped that to 600 million shares. That means they have, what is that? Again, I don't feel like doing it in my head. Should have picked different numbers. 10%, 20%, maybe. Again, I'm doing that in my head. I don't. So if the numbers are off, forgive me. But I'm trying to go through this quick without wasting a bunch of your time with me calculating it. So 10-20% share dilution, which means all else remaining equal, their shares are worth 10 to 20% less than they were, or now they're worth 10 to 20% less now than they were in 2017, just from the share dilution. Again, let's go back to the pizza. Let's say you have one whole pizza to yourself. You can eat the whole pizza if you want, but if you have 5 friends show up, then you only have 1/5 of the pizza if all of your friends eat pizza. Your capacity, or the slices, are smaller because you went from one whole pizza to 1/5 of the pizza. Share dilution works the same. So companies over the long term are based on the profits and the value, or and the cash flows they produce on a per share basis. At the very kind of basic level, they're valued over the long term on their profits and the cash flows they produce on a per share basis. When you issue more shares, that means the earnings and cash flow per share go down, which means the value of the company goes down on a per share basis, which eventually leads to the value, or to the price of the company going down over time. Usually, I would expect this not to be the case here, but usually this means a massive amount of the chart goes from up here, and then there's a massive crash at some point and it ends up over here, and it goes way down due to share dilution. I've shown some case studies where some of these analysis videos where I think the most extreme one was like a 99.6% share dilution, or loss in the value of the shares due largely to share dilution. I said that likely it wasn't the case here because Pinterest is essentially a tech company / social media company, and those are insanely valued right now. So that's why I said this most likely had not lost a ton of value, and it had not. It's actually up 90% since its IPO. But for most cases, this leads to massive loss in share value, and it's not a great thing, especially if the company isn't using their capital well. In this case, because their share price is up, it's one sign that the company is likely spending their capital well. Another thing, again, probably a larger factor, is that it's a social media / tech company, which valuations are absurdly high right now. So it's only had 1 year of positive free cash flow. How can it have positive free cash flow when operating profits are negative by issuing shares, and they may have also issued debt. That's how free cash flow becomes larger than operating cash flow. Or it could also be selling stuff, selling assets as well, but most of the time, especially right now with the craziness going on right now, it's usually from selling shares or issuing debt. The ROIC, again, negative, like the rest of the profitability metrics. I look for anything above 10% on a consistent basis here, so that is not great. Free cash flow to sales, I look for anything above 5% on a consistent basis. They reached that, or they have surpassed that in the last 12 months. Again, likely due to share dilution and or debt, which we'll figure out the debt in a second. That's not necessarily the most healthy way to grow. It's not terrible, again, especially if the company uses the money well, but it's not the most efficient and optimal way to grow in most cases. A ton of cash on their balance sheet. 75% of their balance sheet is made up of cash. That's very good. They have an incredibly low amount of liabilities according to their balance sheet, and no short-term debt, no long-term debt. That is fantastic. The company has a lot of cash on the balance sheet, and essentially in this case, no debt. That provides an enormous margin of safety for the company. Okay, let's go to financials now. We've talked about this a few times, negative interest coverage ratio. This at negative 73.2 is not a good sign. But we already knew this. This shows that the company has negative profitability and that it can't cover the current interest payments it has on its debt. It can't do that because it's negatively, or it's unprofitable on an operating on an operating income basis. I look for anything above 1 in this case, and typically the higher the better, because the more profits the company has compared to its current debt levels. We'll have to see down here if it has a huge amount of debt, but most likely my guess right now is this isn't a huge deal in this case. It's not necessarily a great thing in any situation with this company, but it's not necessarily a massive red flag either, because according to the other sheet, they had 0 short-term and long-term debt. So according to this, they do have a tiny bit of debt though, at $130 million worth of debt, and they have $2.03 billion in cash and cash equivalents. So again, not a huge deal here, because they have such a huge cash pile compared to their debt levels. So this is not a concern actually at all that their interest coverage ratio is negative. Okay. Okay, already talked about their cash. Boom, boom, boom. They're an online company, so they shouldn't have much property. They're a relatively new company, so they shouldn't have a ton of goodwill and tangible assets. And they don't have any of that stuff. They don't have hardly any liabilities whatsoever. So they have a very, very, very clean balance sheet. Very clean, except for this number down here, retained earnings accumulated deficit. With this being negative, this is a total cumulative number over the entire course of the history since it's been public, of if it's made money, what its profits are. In that case, it's called retained earnings. If it's negative, it's called accumulated deficit. So this company, Pinterest, has lost $2.4 billion since it's been a public company. We already talked about that. Not a great thing, of course. Or it's not necessarily a huge red flag either, because it's a growth stock that requires spending money and losing money to continue growing. Other than that, their balance sheet is really clean. And this actually, in a real world sense, doesn't really matter much unless it's like the only time this accumulated deficit and retained earnings is always pretty much a good thing. The only time accumulated deficit really matters in a negative sense is if you're trying to sell the company, because this is a negative drag on the valuation of the company, especially over the long term. You want to see, obviously, most people want to buy a company that makes money. If it's not, in this case, $2.4 billion negative, then it's a drag on the company's valuation. But again, unless it's looking to sell, and when I say sell, I mean sell the entire company to a third party, then it's not really a deal at all. Retained earnings are good because it's kind of acts as a rainy day fund. That's the way I think of retained earnings. Because with the excess capital that you created in profits, then you can grow, then you can buy back shares, then you pay dividends, then you can acquire other companies, then you can do whatever you want with. So that's always a good thing to have. Let's go back here real quick so I can illustrate. Let's go back to the cash flow statement so I can illustrate how much money they raised from selling shares. So where is it? Share issuances. They don't have any in the last few quarters. Payments for common stock. Total issuance. But they have issued shares, have they not? In the last year? Where are we at here? Only a little bit of shares, so we'd have to go back further to see their other shares. So let's go back to the annual numbers. And that big loss, yeah, it's stock-based compensation. So that's why I love the cash flow statement. They have that big loss in 2019 that I talked about over here, about $1.4 billion, and they have an almost exact amount of $1.38 billion in stock-based compensation that year. So it's related to restricted stock units, stock options, bonuses related to certain key factors, depending on what it was ever in the S1 prospectus for when they came, or when they IPO'd. That's what this number is for. So that's why they lost so much money that year. Okay, so they issued in 2019, as part of that, they issued a total of, or a net total of $1.1 billion worth of shares. So that's what happens when you issue a ton of shares. You make money, the company makes money, and then they use it for growth or whatever purpose they want to use it for. But that's what I wanted to talk about there. I wanted to show you that. Okay. Oh. And here's where we get to the valuation stuff. So it's unprofitable mostly on pretty much every metric. So frankly, again, I don't know what goes into Pinterest's metrics here, or into Morningstar's metrics, sorry. But it's unprofitable on an earnings basis. I don't talk about net income. Yes, on a net income basis. It was very profitable on a cash flow basis. So frankly, I'm not sure why the earnings number is showing it all, but it has a PE of 229 rounded up, price to cash flow of 147.6 rounded up, forward PE of 65.4 rounded up. I don't care about any of these numbers for the most part. I care more about enterprise value to operating income, which is usually down here, but again, they are not profitable on an operating income basis, so that doesn't show up down here. I go into that in several videos, why I don't like PE and stuff like that. You can find that on my blog or whatever, or in some of the other videos, so I'm not going to get into that. But when I do look at them, I want these to be underneath 20 to show that the company's undervalued. These are far above that. EV to EBIT, it cannot show the EBIT, which is operating income, because it's unprofitable on an EBIT basis. So instead, Morningstar substitutes enterprise value for EBITDA, which I do not like. This, I know it's not exactly the same as net income, but it's a somewhat similar proxy for net income. I don't use net income. It's easy to manipulate. It's far easier to manipulate than cash flow, because you can, if you have good enough accountants and lawyers, or there are a lot of reasons that I go into on various blog posts. But a big reason is because it's easy to manipulate the net income. Depending on if you have good enough accountants and lawyers, you can make your tax rate essentially whatever you want, especially if you're a US-based company. So because of that, I don't like net income or EBITDA. I guess, again, I know they're not exact proxies, but they're similar enough. But on this, they have a ratio of 1,529. No, enterprise value to EBITDA is not an exact apples to apples comparison for enterprise value to EBIT, which is operating income. But because, again, I've done enough of these valuations, the enterprise value to EBIT, if, again, Pinterest were profitable on an operating income basis, would be somewhere in the $1,200 to $1,300 or $1,200 to $1,300. I said it again, $1,200 to $1,300 ratio here. On an EV to EBIT basis, I look for anything below 8 to consider a stock undervalued. So Pinterest is enormously overvalued right now. Kind of what I figured from, again, knowing this industry and seeing that it's on profitability, knowing it's a growth stock in the tech arena, social media arena. I kind of figured it would be overvalued. Didn't necessarily think it would be this overvalued. Because of this, there's no way I could recommend with my criteria for my investors to invest in this stock right now. If you already own it, that's fine. If it fits your criteria, that's fine as well. But for my investors, for what I require from an investment, I could not buy Pinterest right now. I'm an ultra conservative value investor. Again, I don't care about the story stuff until later. I don't care about the potential, very little, frankly. And that's way later. That's after I read financials, and that's still 3 stages down the road from where we're at here. But this criteria here shows me that while Pinterest is a decent stock, that it's far too overvalued for me to consider buying, especially when you consider its unprofitability and stuff like that as well. So again, it's not a bad stock, it's not a terrible stock, it's just massively overvalued, and that's happens for a lot of stocks today, and this might change a couple years down the road, I don't know. But for right now, with what I require from my investors, I could not invest in Pinterest, and for that reason I wouldn't do any further analysis on it right now either. So I hope this helped. Joel B, making sure I have the right name. Yes, Joel B, thank you for asking me to evaluate Pinterest. Hope everyone else enjoyed this analysis. To answer the question I asked, should you invest in Pinterest, I would say no. Especially if you're looking to buy new. If you've had it for a while, it might be a different story. But I'm basing it right here on what the information I have today as a new investor. Again, for a new investor, I couldn't recommend it for new investors for the reasons I outlined. If you want to get a video, or if you want to get a stock analyzed like Joel B and many others, pretty much for the last 3-4 months, every single video I've done has been recommended, stock recommendation from a viewer. If you want me to review, not recommend, if you want me to review and analyze a stock for you like this, let me know in the comments below. I'll analyze a stock from anywhere in the world, as long as it's not a bank, because I don't evaluate banks, as long as it's not an insurance company, because you actually have to dig into the annual reports to analyze those, and it has to be generating some kind of revenue. If it's not generating any kind of revenue, we did a couple of those, and they were kind of boring, frankly, because there wasn't much to talk about, because at this initial stage, I have to have numbers to evaluate stuff, because stuff has to meet my minimum criteria before I go further. So other than that, a stock anywhere in the world, let me know, and I'll look at it and I'll analyze it for you. If you like this video, make sure to like, love, share, subscribe, and comment, and all that good stuff. Also, make sure to hit the subscribe and hit the notification bell, so you're notified every time we release a new video, and we release new videos all the time. If you're listening on my podcast, we'd really appreciate all that same stuff as well, but we'd also really appreciate a review, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more specific help on how to become a better investor faster, you can grab our free resources below. 5 free gifts, which you can get the full written template for this process, the visual process we did here. I have a full written worksheet you can grab with our 5 free gifts. You can also get access to my book, How to Value Invest, a PDF copy of my book, How to Value Invest, for free as well. You can also get our free guide, 7 tips to pick and rate stocks 3 times you must sell. You can get all 3 of those for free at the links below. And if you're looking for more specific help from me on how to become a better investor faster, you can also check out information on our masterclass below this. But until next time, have a great day. Talk soon. Bye.